All right, David Levy is chairman of the Jerome Levy Forecasting Center, publisher of the oldest economic newsletter in America. In March of 2007, David forecast U.S. housing prices would drop 30 to 50%, and by this past April, the S&P Case-Shiller Home Price Index had proved him correct. Now the index is edging up again, so the question becomes, is the worst behind us, or is this just a dead cat bounce, as we just heard from Joe Saluzzi? David, welcome to the show. Let me ask you, first of all, about the housing mess here. It was at the crux of this recession at first. Are we looking finally at a bottom here, and is it still key to the recovery?
No, we're not looking at a bottom. I don't know if I'd even call it a dead cat bounce, because I think we're going to have a series of little bounces along a generally erosive pattern for the next few years. The fundamentals behind housing are still very, very weak, so we have to look elsewhere for recovery. And in fact, the present fledgling recovery we have is based on two things: huge federal deficit spending and the turn in the inventory cycle, nothing else.
Now, we were talking about deficits a lot. We've been talking about them a lot over the past months, but today as well. You say that they are necessary, that this deficit spending is necessary to bring us out of this.
Well, it's not even just necessary, it's almost unavoidable. If we try to reduce the deficit, it will undermine the economy so badly the deficit will widen again. And if we, so whether we spend deliberately and spend wisely, or just simply have tax revenues fall off because the economy is so weak, we're going to be running big deficits. The problem is the private sector engine of growth, the engine that generates profits, can't work in this recovery, and can't work probably very well for the next several years.
But those who are concerned about the levels of debt, peak debt, and the debt chart going hyperbolic, to them you say that we've seen this amount of debt here in the U.S. before, other countries have seen it before, and we can deal with it. If the economy picks up, we can definitely, you think, begin to pay it off and not be terribly concerned about it?
Yeah, I mean, again, if I thought we had a choice and there was a nice way to get through this period without running a lot of debt up for the federal government, I would say great. But I think we're going to run up a lot of debt. We now have approximately 60% ratio of total government debt held by the public to GDP. That's up substantially from got down into about 32% or so under the Clinton administration, not necessarily because of Clinton, but because of circumstances. And it's back up, moving very rapidly now, but it was as high as 110% of GDP after World War II. I think we may well, before this decade is out, break that record, but I would also point out that they're temporary problems. Even if they're going to take a number of years to work out, they are temporary problems that will enable us, that we will get behind us and then get that number down very rapidly.
Nonetheless, they clearly require a substantial economic recovery to deal with. Do you see that happening here? I mean, you coined the phrase contained depression back in the 90s. Is that what we're facing right here, where maybe this recession technically could end, but we're still in a period of economic malaise for a long time?
That's exactly what we're in. And, basically a depression, unlike a recession, which is a short-term problem, is a long-term problem when you just simply have so much debt on the balance sheet of the economy and so much overbuilding of assets and overvaluation that takes a long period to work that off. We've seen the same thing happening in Japan. I don't think it will take as long here as it's been taking there, but I think we're looking at something on the order of a decade, maybe a couple, 2-3 business cycles to work completely through this. But the good news is that it is contained. That is, the government isn't being an effective lender of last resort. We have not had the disasters we could have had if all those financial institutions last year had failed, and we have not had a complete collapse of private profits the way we had in 1932. Despite the fact that wealth creation in the private economy ground completely to a halt.
Now, you say, nonetheless, that this time it's different. You say really what we're looking at is something different than you've seen in the past recoveries as far as the economy coming back in the business cycle. Why is it that, I mean, your newsletter has been published for 60 years now. What makes this time really different than that period when you look back?
Well, one of the big differences, if we look back, particularly the last quarter century, is every time we had an expansion, there was a greater element of bubble behind it. Bubbles creating wealth that led to excess spending, bubbles leading to excess investment in real estate and business capacity. And every time we got into trouble, the Fed responded by cutting rates to a multi-year low, which enabled us to refinance our way out of the problems. We ran out of room for the Fed to cut rates. Rates went to zero. We still haven't been able to fix the housing mortgage problems, the excessive consumer debt problems overall, and for many sectors of the business sector, excessive debt problems as well. So we now can't play this game of cutting rates. We have to now just start working the debt off.
All right, David, thanks so much for joining us. David Levy there from the Jerome Levy Forecasting